Shopify is at 52-week lows and is down over 75% from the highs of 2021, which were at $1,500 per share. The stock really benefited from the government stimulus over the last year or so, but it's really struggling at the moment, which is the reason for the sharp decline. So it has to make you wonder where Shop goes from here. Is Shop undervalued? Are we heading towards a margin of safety? Or should we completely disregard this business? Well, keep watching to find out, as we'll be talking about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. But with that being said, today we're going to look at Shopify's Q1 2022 earnings results, where we'll be taking a look at the financials. We'll then take a look at the technical setups to see what is playing out. And as you can see right here, this is how we can measure that they've been down over 75% for this year alone. And then finally, we'll conclude with the valuation of the business. And then we'll conclude with the valuation of Shopify's business so we can determine whether or not Shopify is a great investment for our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. All right, so before we jump into the earnings highlights, let's quickly take a look at the technical analysis for Shopify at this current point in time. So as we previously saw, we're down 75% for this year. If we add in our drawings, we can actually see where exactly the support is for the stock, where the resistance is, and etc. So we can see up here was the highs. Of course, this is going to be our resistance levels, and we've pushed down since then. And I've just gone ahead and drawn in these resistance and support lines here, which are going to be resistance when the stock is below these levels, and then support when stock is above these levels, as we've seen here, right? And so currently we're at a point where all these lines here are going to be resistance as we've fallen down into this green zone. This green zone for 4, if we scroll back out, we can see that this was really a key turning point in the stock, because from this point, once we gained a foothold down at 300, we kind of didn't look back since. Now that we're back here, it's going to be interesting to see whether this 300 level can hold up after all. And I think that's kind of where the stock is going to at this current point in time. There's going to be a lot of buyers probably in these 300 levels. So we're actually at a very interesting point right now as we're into this green zone here. And we know that there's some support down here at 300s. After hours, as you can see, we're at 411, so we do have $100 to still fall if we are going to get down to this 300 range. But this green zone, in general, should be holding as support. The stock should rebound from here if it is going to gain a foothold at all, and we should be targeting. I don't know if we'll get back up to 800s, but yeah, we might bounce here, consolidate for a little bit until we can see what happens exactly over the next few quarters, because as you'll see in just a second, Shopify does expect to have a tough 2022, but they do expect at the same time to rebound late 2022. So anyways, we'll get into that in just a second when we get into the earnings highlights. I just wanted to quickly go over this technical analysis for you. If we do fall below these 300s, guys, we're probably going to see somewhere down here into this 170 range. I mean, it's not going to look good for Shopify, but that's the technical analysis for right now. Let's jump into the earnings analysis. All right, so looking at their earnings highlights for this Q1 report here, we can see that they had revenue of $1.2 billion. This is up 21% year over year. That's actually strong, but they did end up missing by about $40 million, so that's noteworthy. Okay, we're going to move on to their earnings per share here. This they reported as 20 cents per share, which was also a miss of 45 cents. So effectively what we're seeing here is that despite the revenue growth and such, they're missing on their analyst expectations, and that's never really a good thing for any stock. Besides that, though, we do see that their monthly recurring revenue actually did increase by 17% year over year to $105 million. Subscription solutions revenue also increased by about 8%. Their gross merchandise volume increased to $43 billion worth for Q1, and that's up 16%. So they did have some good things going for them this quarter, but at the same time, with the earnings misses, the analyst misses, it taints just a little bit of a bad picture for Shopify for Q1, the start of 2022. We look down here towards the outlook, and we see that they've made mention that, like I said earlier, revenue growth will be lower in the first half, and then they'll see strong growth within the fourth quarter later in the year for 2022. They've just mentioned that this guidance is it's poor, and it's due to the lack of COVID stimulus present, I should say, in early 2021. And something that I actually found was interesting about their earnings release was that they mentioned that they want to reinvest all of their gross profit dollars back into the business to pursue growth, and especially across geographies. So really what they're trying to do is recoup their losses, reinvest back into the business, and make the stock price eventually go higher and reward the shareholders that way. So let's jump into the financials and see how exactly that is going for them. So starting with their statement of operations here, we can see the revenues. So they're broken down their revenues in basically two sections, which is their subscriptions and their merchant solutions. So from subscriptions, we've seen growth, and also we've seen some growth in their merchant solutions, right? And of course, merchant solutions they're going to profit more from, and that's why that's a larger figure, right? So we get to $1.2 billion worth in revenues. Now we have to move on to their costs of revenues. So we have 77 million from subscriptions, 488 million from merchants. That brings us to a total cost of 565. This is up from 429 a year ago. We get to 637 million for gross profit. Okay, now we need to deduct some of our expenses here. Again, this business needs to advertise more. They're trying to get back to where they were over a year ago. Do I think it's possible? It's possible, but it's not that likely. But they are trying it nonetheless. So, I mean, almost 50% increases across the board. And that's why total operating expenses actually did increase by about 50% overall. And with that number, we finally get to the income from operations, which actually turned out to be a loss of basically, let's say, $100 million US. Okay. Now, if we compare that number to what they had 1 year ago, they had about $120 million profits for the quarter of Q1. So, yeah, you can really see the contrast over what's happened since the government has stopped with the stimulus, and Shopify is really struggling from this. Now we deduct our other expenses here, and we get to this figure down here, which effectively is our net loss for the quarter, $1.5 billion. Again, last year, around 1.25 billion in profits. So, I mean, there's this large contrast in what's going on over the past year or so for Shopify. And if we scroll down here, we'll also see that they are diluting shareholders as well. So that's another thing that you don't want to see, but it is kind of what you would expect from a business that is losing money. They're really not going to be buying back shares. So if we scroll down here to our balance sheet, we'll actually be able to take a look at their assets, liabilities, and really, again, like I always mention, we want to see what's going on with their debt and their cash. Okay, so if we take a look at their total assets, we can see they are just down slightly. Really, it's this number here, this marketable securities figure, that has made that difference. If we keep on scrolling, we can see again, looking at their total assets, these are down. And we can see here that the reason is actually due to this decrease here in their equity and other investments. All right, not too important. Let's move on to see what's going on with their debt. We can see that they actually have convertible senior notes. So that's interesting. That's flat year over year. But if we add this along with, let's just add in their lease liabilities to be as conservative as possible here. Let's give them $1 billion in debt. Compare that with, if we scroll up here to their cash, right? So that's about $2.5 billion. Yeah, we can say that their debt is serviceable, and that is good, especially for a business that is struggling. You don't want to see them racking on too much debt, trying to recoup their losses, because at that point it becomes a downward spiral, especially when the debt is no longer serviceable. So that is good, regardless of the fact that shareholders' equity down here has actually decreased year over year. But anyways, let's move on to the statement of cash flows, and this is going to be a little tough to do because we can, as you can see here, they're actually reporting a negative figure for their net loss, right? So it's going to be hard to add back in everything and get to a positive figure. And actually, if you look at their calculations, they struggled with all the financial engineering, as some would say, that goes on in this section of the financial statements. But let's still take a look at what they did for the quarter. We can see they had capex here of about 500 million. And besides the exercise of stock options here, not really much has changed. But let's jump over to our calculator and see how we can actually evaluate this business. All right, so before we jump into our calculator, let's actually try to find what we can use as a previous figure for the calculator, since they have negative earnings for this quarter. And if we look through, we can kind of see what our options are here for their previous earnings over the past like 10 years or so. So, I mean, it's either they're negative or they're insanely high. So we can try to use this $3 figure as to say that this could be a potential return to value. So let's say by the end of the year, they can actually get up to $2.50 for the year. And let's try to translate what that would look like for our calculator here. So if we actually change this to their earnings per share figure, let's say they can make $2.50 for a 10% return. They don't pay a dividend. I mean, guys, if we don't even change anything here, we can already see these numbers. They're way off of where they currently are. Mind you, this stock is currently at $400 per share. And partially the reason is because just last year they had an earnings season where that came in at, for the year, about almost $23 per share. So yeah, that's how these evaluation metrics got so inflated. But I mean, without the stimulus, we're gonna see a nice decline here. So let's try to be as optimistic as possible. Let's say they can even get to, maybe in 2023, 2024, they can get to, let's say, let's give them $6 per share. Yeah, that's when we'll see. Still, they'd really be struggling here, even with these optimistic earnings growth rates here. Yeah, we'd be looking at a stock price of about $161 or 250 in an optimistic point of view. So it's not looking good for Shopify, guys. And if we look at the stock chart here, yeah, we can see that why exactly the stock has fallen off a cliff, really. So a question I get asked a lot is, would I be a buyer? Absolutely not for Shopify. This business needs to prove itself to me. It doesn't make me want to invest in it at all. And really, this is just a classic example of what happens when the growth stops with growth stocks, right? So Shopify was really dependent on their growth, massive growth numbers, massive growth metrics, and since they didn't hold true, yeah, we can really see what the result of that was. So that concludes Shopify's earnings analysis. Thank you for watching if you made it this far into the video, and until next time.